What are some of the gotchas or the key misconceptions or things that you think they need to be aware of from a legal perspective starting out when it comes to real estate deals, and specifically syndications?
I had one client in a hotel deal where the entire fifth floor was black mold and the property manager wouldn't let him go to the fifth floor. The seller told me not to let you up here because of the black mold and they didn't want you to see it. A $50,000 renovation surprise is enough to move the needle to not worth investing in anymore. Regardless of the market, seller's market, buyer's market, it doesn't matter. The seller has 100% of the leverage until the contract is signed. Because they don't have to pick Jonathan's LOI, they don't have to pick Kyle's LOI, they could pick Sarah's, right? The LOI should be in the name of an LLC, not your individual name. I don't know anyone out there that has a portfolio worth writing home to mom about that is submitting LOIs in their individual capacity. One phrase that you'll probably hear a lot is other people.
Hello, everyone, and welcome back to the Apogee Wealth Podcast. I'm incredibly excited about our guest today. You know, people are always talking about wanting to talk to an attorney or ask an attorney questions. Well, today is my lucky day to do just that. And so I have my good friend and attorney, real estate attorney on the podcast with us today, Kyle Swafford. Kyle, welcome to the show.
Thank you for having me, Jonathan, and truly the honor and pleasure is all mine. Thank you for having me today.
Yeah, absolutely. And I think we're going to have a great conversation that will be a lot of value to the listeners. The first question that I have is just when you were growing up, what made Kyle think, hey, I want to be an attorney, and even more so a real estate attorney? Like, how did you get in the business? How did you get attracted to the world of, legal stuff? And I'm just kind of curious to hear the origin story there.
It's funny. So I knew my whole life I wanted to be an attorney. There was never a situation where, and I say whole life, I definitely mean like 8 years old and up, 10 years old and up. Like, I'm sure at 5 I wanted to be a fireman, I don't know. But I remember when I was young, probably too young to be watching said movie, but I watched Liar Liar with my dad, an old Jim Carrey movie, to kind of date myself here a little bit. And I just thought it was hilarious. I thought it was funny. And I don't know, I just was like, I want to be an attorney, And then I really did, I grew up reading like You Be the Jury detective books and legal kind of books. I remember when we had like career day role plays, I was randomly drawn to be an attorney. It just kind of felt like there was just this divine intervention, at the risk of being a little silly here. In college, I always wanted to know what the beer pong rules were, So in terms of the full range of the story there, and I get into law school with the idea that I would be a trial attorney because I'm extroverted and whatnot, but I also had a real gravitation towards business-related classes, particularly corporations, partnerships, and certainly I took all the tax classes I could. And then I went into an LLM program, which is a 1-year master's in a specific subject after law school. I got an LLM in tax at the University of Florida, where I met my wife, and kind of bounced all over the place. I kind of started largely as a tax attorney and then kind of stumbled into a commercial real estate and SEC compliance law firm in the summer of 2021, which is ironic because in law school, property and contracts were far and away my worst subjects. But it's what you learn in law school versus what happens in real life are just different things, right? Like in law school, I'm learning about water rights, and that's not really something you deal with on a multifamily transaction, right? So when I realized, it's probably just contracts, and contracts aren't too tough for me, I didn't look at it as property. I looked at it as contract law. And then, 2 weeks in, I really got my grounding. 2 months in, I knew it was something I wanted to do the rest of my life. And after a year and a half at that firm, I started my own firm January 2023. And, we're still here today. So that's kind of the journey that I've been on from where I started, what I wanted to do, and kind of how I got to where I am now.
That's awesome. That's super cool. I've wanted to know that and didn't, and it's cool talking about like the real world versus textbook, because I was gonna jokingly tell you I got my legal degree from watching Suits. So
Yeah.
I don't know, I don't know how pertinent anything is that I know, but I know you have a lot of value for the listeners. And so, a lot of the audience of this show is people who are, they're active to some level in multifamily, right? Maybe they're on the lower end, a limited partner, but they understand the business and some of the legal stuff to think about. And then maybe they're a newer general partner and they're trying to like set up their first deal, look for their first deal. And so I want to speak a little bit to both of those groups. We'll start with the active investors first. You work with a lot of active investors on real estate. What are some of the gotchas or the key misconceptions or things that you think they need to be aware of from a legal perspective starting out when it comes to real estate deals and specifically syndications?
Yeah, so one of the viewpoints that I have in terms of like kind of how I operate my firm and advice in general is that any attorney can give you legal advice, like what the PSA says and stuff like that. But I don't think enough attorneys kind of dumb themselves down a little bit to give practical advice. So I think a lot of this conversation today might seem obvious or practical, but that's kind of the point because that's often where these things get missed. So I think from one of the biggest tips that I think I could probably give someone starting out is once you get the property under contract and whatnot, or actually before that, it goes hand in hand. In the PSA, you need a clause that says seller will afford buyer the opportunity to tour every unit. That's critical, and I'll get to why now. When you're doing your inspection, you need to tour every unit because I mean, just off the top of my head, I had one client in a hotel deal where the entire fifth floor was black mold, and the property manager wouldn't let him go to the fifth floor because of construction. And they finally just forced the issue, and the property manager told him, "Look, the seller told me not to let you up here because of the black mold, and they didn't want you to see it." I had a client that the elevator shaft was closed because they were operating on the elevator, and when they finally just wanted to take a peek inside, they saw a bunch of broken hypodermic needles. And that's not even a unit situation. That's just, I don't know what you would call that, the common area, I guess. There was one situation, this didn't happen to my client, but it happened to a friend of his in the multifamily space. They wouldn't let the potential buyer tour in a specific unit. It was either down or a pit bull was there, an aggressive dog, whatever, I don't know. But a woman lived there. She was very old and physically couldn't really get up to let her dog relieve itself, so she just let the dog go into the guest bedroom and just use the bathroom in the guest bedroom for several months, maybe even a year. And by the time they acquired the property, I mean, it was like 30 grand to fix out that room and clean everything out. So, I'm not going to suggest that every seller has something to hide. I'm just saying that you owe it to your own operations and investors to be as thorough as you possibly can. And a lot of times it's easy to think about these big picture things like foundation, parking lots, roofs, but there could be mold, there could be down units, there was a fire and it's not even CO'd, and that would be on some deals, a $50,000 renovation surprise is enough to move the needle to not worth investing in anymore, So I just tour every unit. And if they just simply will not let you see a certain unit, I'd get something, and I need a reason why. Maybe the tenant could just record the walls just so that you can see that the appliances are there and they weren't stolen or something. I don't know. With enough time and opportunity, there's going to be enough surprises in this space, and you just want to make sure it's not happening to you.
Yeah, that's really good advice, and like you, I could tell several stories on why that's important. When it comes to investors submitting their first offers, right? Because at least in my mind, and correct me if I'm wrong, that's really where the rubber starts to meet the road from a legal perspective on deals. So someone's crafting their first LOI for an offer on a property. What are some of the key things you want to make sure are in an LOI to set you up for success in PSA negotiations later?
Yeah, so I think when you're drafting almost anything, doesn't matter what it is, I think you should always draft it from the perspective of who is the audience. and try to pretend that you're the audience for a second, right? So your audience for the LOI is 100% the broker, because it may not even get to the seller, right? It's definitely going to get to the broker. And brokers get paid at closing, right? Exclusively get paid at closing. So if your LOI is conveyed in a manner that it looks like you're a beginner and the broker might think that you can't close, you're probably not going to be too successful in getting that LOI submitted. So a couple of tips to look a bit more sharp would be the LOI should be in the name of an LLC, not your individual name. I don't know anyone out there that has a portfolio worth writing home to mom about that is submitting LOIs in their individual capacity. I just don't know that person. Maybe someone is, but I don't know them. Full align. When you go into Microsoft Word, you can left indent, center, do full because it makes it look crisp and it's easy to read. And just make sure there's not any typos. Your LOI is max 3 pages, and that's assuming one page is dedicated entirely to expected due diligence materials, right? Your letter of intent should not exceed 2 pages. It would take you 3 minutes to spell check it. Don't call yourself a buyer in one sentence and a purchaser in another. But most importantly, don't have conflicting clauses. Like, I've seen it to where while the LOI, as you know, is a non-binding agreement, it is absolutely the starting point where the sellers will hold you to in negotiating the purchase and sell agreement, right? And I had a situation early in my law firm's career where our client had a run-on sentence. It was clearly a run-on sentence. It was something like, the financing contingency period shall begin 15 days after the expiration of the due diligence period. The financing period will be 40 days after the effective date. Like, it was like a run-on sentence. It was clearly like these were one of 2 sentences, pick which one and delete the other type of situation. Well, right. It didn't get deleted. And which one do you think the seller stood firm on when they were negotiating the purchase and sell agreement, right? So it doesn't really matter, what the buyer meant anymore. The seller is going to kind of take the LOI at its word from their standpoint. So, and one last thing kind of on this point, regardless of the market, seller's market, buyer's market, it doesn't matter. The seller has 100% of the leverage until the contract is signed. Because they don't have to pick Jonathan's LOI. They don't have to pick Kyle's LOI. They could pick Sarah's, right? Like, even in a buyer's market, the seller can still pick who the buyer is, right? So until the seller signs, you don't have any leverage. Once the contract is signed, though, then the buyer has all the leverage, whether you terminate during the inspection period or not, whether you exercise a closing date extension or not. All these things, like, you control the timeline at that point. So make sure your LOI is clear and understandable so that once you go to the PSA negotiations, everybody is on the same page instead of kind of starting behind the 8 ball.
Yeah, 1,000%. I think, as buyers, we want to move from that LOI to PSA signing stage, as quickly as we can. And I think everyone wants it done correctly, right? But from a seller's perspective, you really got to, dot your I's, cross your T's before signing the PSA, because you're at the buyer's mercy at that point, right? And their ability to execute once it's signed. So
yeah, can I get one more? Can I get one more thought on?
Yeah,
on
yeah,
that?
please.
One thing too that I even see sophisticated operators fail to do is you should put a clause in the PSA that the buyer will provide the first draft of the PSA to the seller. And what this will accomplish 3 things simultaneously. 1, it'll show initiative, right? They're not having to come out of pocket on legal fees yet. You'll submit the first draft of the PSA. 2, it indicates that you're not willing to sign a broker PSA because, they tend to be vague and lack specificity. And at the end of the day, realtor forms and broker forms are going to be seller friendly because they're the ones that pay the brokers. Like, what broker would ever prepare a purchase and sell agreement that's buyer friendly? It just doesn't exist, right? I'm not saying they're adversarial to buyers. I'm just saying they're not looking out for your interest in the negotiation of the contract. And then the third thing that it does is it allows your attorney to draft a pro buyer document that is now the home field advantage where the negotiations are going to take place. So, the LOI is probably the first and last document that's ever going to be drafted with 100% of your intentions in mind. So you ought to set it up as best as you can for yourself, right? And usually having that clause that you'll provide the first draft of the PSA will help, you starting from a position of strength instead of kind of behind the eight ball.
Yeah, absolutely. One other little LOI question, terms, specifically earnest money. And, as an investor, I can caveat and say, obviously, this is market dependent, right? If you're in middle of nowhere, Nebraska, it's going to be different than here in Dallas. But what are you seeing in general on earnest money today? Obviously 5 years ago, everyone was hard money day one, and if you weren't going to get a deal. But there's a lot of mixed. I get a lot of mixed input from the investment community about what's working, what's not working today. What are you seeing on your end?
This is such a good question. Man, what a great question. So, I think maybe what you're getting at is, are you seeing non-refundable day one slowly starting to creep back into these negotiations? And I would say it depends on the market, like your Phoenixes, Atlantas, Dallas, Houstons, things like that. Maybe Austin, Jacksonville. Those are probably Tampa more so than Jacksonville, but those are probably areas where it's entering the conversation. And I have been advising clients to address that one of two ways recently. It's so funny that you asked this. I think the first thing that you could do is tell the broker, instead of non-refundable day one, what if we do kind of a 30-day inspection period? I want time to inspect the property, but it'll be non-refundable after day 7 and released to an account of the seller's choosing. It's still applicable to the purchase price, but it'll be released. And the distinction I'm making there is, just because something is non-refundable doesn't mean that it is ever releasable. Even if the contract says that the EMD is non-refundable day one and shall be released to the seller, you could contest it. Most title companies aren't going to release the EMD if both parties aren't signing off on it, particularly of large scale 150K or more deposits. Now you're just kind of playing hardball. You're probably going to be blackballed by the broker and whatnot and stuff like that. But I don't know, maybe they committed fraud on the T12, and by the time you actually got a legitimate T12, it was a completely different NOI, a 20% drop in NOI. You would have never entered into the agreement if you would have known that. So maybe there are, legitimate, fraud claims and bad practices claims. So my point is, if you make it to where, hey, we can avoid all that if you just give me 7 days. Because after 7 days, I'll know if this money is not only worth going hard, but released to the seller. And the benefit that the seller can get out of that is, if I terminate on day 7, you can just go back to the person that was in second place on the best and final offer. And I haven't wasted a bunch of people's time. They're only out 7 days that I was doing my DD, and nobody's really hurt here, Yeah. So instead of making it non-refundable day one, make it released on day 7, and then you can kind of spend the first 3 days hounding the broker for the due diligence materials, making sure that financially the deal makes sense. You can kind of rush and buy a plane ticket, tour the property, on the 5th and 6th day, and then kind of know, okay, the physical condition of the property makes sense, the financial viability of the asset makes sense, and then you can kind of go, all right, I'm willing to roll the dice at this point. That's strategy number one, a release strategy. A second strategy, and a bit more colorful from an attorney drafting standpoint, is, I did this recently. I had a client where the money went non-refundable day one, but I gave my client 5 business days to provide it, and the money didn't become non-refundable until it was deposited. So, what that did is, it gave my client, in essence, a free 7 days to see the property, review the financials before ever having to make the deposit. Is that shady? I don't think so. I mean, I think depending on the size of your deal, you might need 3 or 4 or 5 business days to pull the sources together and whatnot, right? So it worked. Sellers Council didn't really catch what I was doing, and the PSA was signed, and there we go. Now the client ended up making the deposit because the deal worked out in that way. But my point is, give yourself 3, 4, 5 business days to provide the EMD, and then maybe you can kind of get a free 3 or 4 days, right?
Yeah.
So that would be the two strategies that I would recommend to people who do not want to provide EMD literally day one that goes non-refundable day one. Those are kind of two savvy ways to sort of protect that.
Yeah, absolutely. I hope you're enjoying the content of this episode. I want to take a quick 15-second break to thank our sponsor for this episode, which is Apogee Capital. Now, Apogee Capital is our private equity firm that we allow investors to participate in large-scale multifamily investment opportunities through. If you're interested in being a passive investor and would like to learn more, you can find information on our website, www.apogee.com. Link is in the show notes. Now, thanks and enjoy the rest of the episode. Kind of switching to the other spectrum of the audience, Kyle. We also have some listeners that are limited partners or maybe interested in being limited partners on a deal. So for those of you that aren't familiar with that, it's someone that just invests passively with someone like ourselves at Apogee Capital or another sponsor. And so you have capital in the deal, but you don't have active control or responsibility on the deal ongoing. What are some of the legal things that you would recommend new passive investors really pay attention to on legal documents for investment opportunities?
Yeah, so from a legal standpoint, I don't know that I have much. I mean, most PPM templates or most PPM documents from any decent law firm is just going to show managerial control lies entirely within the manager/GP team, whoever that is. So there's usually not a whole lot from that standpoint. I think where investors, if I can just be frank, make mistakes is they don't do enough underwriting on the operators themselves, and they kind of just like, oh, I like the asset. It's like, well, you can like a car, you can like a 1960s convertible. But if you put the keys in the hands of a raging, speeding alcoholic, it's probably not going to end well for the car, right? So my point is, I think LPs need to spend a bit more time, not grilling operators, but asking very pointed questions. And frankly, I don't think enough people do that. I think a lot of investors, got, I don't know if bamboozled is the right word, but they invested money with people who had the best social media presence. Is social media presence an indicator of successful operations? It shouldn't be, right? It shouldn't be. So I think what I would do if I were an investor, I would ask the operator a couple of questions. One would be, what is the way that this deal loses all of my money? What has to happen for that to take place? And what are you doing to ensure that it doesn't? Right? That's a pretty good question. It makes the operator say, well, I mean, I think it would have to be that occupancy dipped and, interest rates went up. And it's like, well, couldn't you fix that with the rate cap or fixed debt? How are you making sure that your operations are good? And maybe that's, well, we have vertically integrated property management. I don't know what the questions and answers would be. Well, I don't know what the answers would be, but I would want to know, where is my risk here? What are you doing to mitigate it? Because I know it's not you don't have a crystal ball. I know that it's not a perfect world, but that would be my first question. I would want to know what an operator's failures were and how they learned from them. If an operator says that they've never had a deal that really lost anything, that could be true, but it would be something I wouldn't say red flag, but it would be something I kind of highlight. Like, I don't know, has this individual gone full cycle yet? Have they been kicked in the teeth yet? What did they learn from it? A lot of people like to think of failure as a bad thing. It's certainly not a good thing, but People that we look up to, Mark Cuban, Alex Hermosi, Dan Martell, Gary Vee, Layla Hermosi. There's so many men and women who are successful nowadays purely because of hard work and failures that it doesn't really make sense to not hold that same standard to the operator. So I would want to know, like, what have you learned from your biggest struggle on operating an asset similarly? And then I probably want to know what assets they have in that portfolio that are similar to this one and in similar markets. Like there was a time during COVID when people were just doing deals all over the country. They had one in Miami, then they had one in Nashville, then they had one in wherever. And, what's the strategy? Why? Things like that. So I think a lot of times investors will ask questions about maybe the asset or something like that, but I don't think they often enough ask questions about the operator and their philosophy on operating. And I think that could avoid a lot of heartache, right?
Yeah, that's some really great advice. I agree 4,000%. I would say that I think one of the reasons a lot of investors don't, is they think of real estate as strictly an investment, which it is an investment, but it's also a business, right?
Mm-hmm.
And so if I was going to go invest in someone opening a restaurant, I would want to ask all the questions pertinent to that business that you just mentioned. But I think sometimes people think, oh, it's just a piece of real estate and it just kind of runs itself. And that's simply not true. It is a business. You have to know how to run it. Third party PM will not do everything perfectly. And the sponsor, the operator, has to fill in their gaps. And
Mm-hmm.
their ability to do so is oftentimes what determines if the project is successful or not. The other thing I like you mentioned is talking about failures, because I think that when I got started in the business around the same time you did, it sounds like during COVID,
Mm-hmm.
and at that time no one had a failure story, right? Operators that were not very good were still making money just because there was so much tailwind in the investment world. And I would say today it's the exact opposite. Everyone has some kind of war story. Some of them are a lot worse than others, but everyone has a story that they can share with investors about when something went wrong and what they did to fix that. So I think those were two really good points.
Yeah, I think too, if I may go back a little bit, it is true that asking some of these questions could possibly alleviate some future heartache, right? But I also, I do think some operators get a really tough rap at times because, like, if you went and invested in the stock market and, a president instituted some sort of economic policy that, kind of tanked the stock market for a little bit, or you invested directly in Coca-Cola and it dipped. I think Nike is dipping for whatever reason. I don't know. You just, like, most people don't try to sue the CEO. You just kind of blame it as, man, this was the risk of investing. Maybe I didn't know what I was doing in making this investment, or I thought it was sound and it just didn't work out. It's a little unfair to not hold that same standard in passive real estate investments, because, like, the operator could have done everything right and the money was still lost, but they don't get the luxury and the benefit of being treated like any other investment that just might not have gotten the right timing on things. I had a client, for example, sold a deal in Texas, I think last year or two. When he bought the property, he had a 5-year goal. By the 5th year, he had achieved the rents that he wanted to see in the 5th year. But what he didn't underwrite, and what nobody could have at the time, was that insurance would double, likely triple in Texas, and property taxes skyrocketed. And then he sells his deal, and some investor equity was lost, and he didn't really do anything wrong. Sometimes the operator could have not done anything wrong, and fit still hit the shan. Right? So I'm not saying that bad operators shouldn't be held accountable, particularly the ones that are committing fraud or whatever that may be, and I'm sure there's somebody doing that, right? But what I am saying is that even sometimes I think investors need to ask themselves, did I underwrite this asset well? Did I understand the investment? Did I ask the right questions? Did they do anything grossly negligent or fraudulent? And if they didn't, I don't know that we need to be raking people over the coals. Sometimes investments just go sideways.
Yeah, and I mean right. Real estate's cyclical, just like the stock market.
Hmm.
And I'll tell you one big different approach that we've had is we've always, obviously, like every good syndication group, we've always had the PPM and stuff with the ominous language about you can lose all your money. But I would say our tone in talking to investors has really changed. In 2021, it'd be like, yeah, Kyle, if you invest in this deal, you could lose your money. But it was kind of a, yeah, this is a possibility, but very unlikely to happen. Just like, if you invest your money in Coca-Cola, it could go down, but it's very likely to go, not likely to go to zero.
Hmm.
Um, and that was kind of our sentiment. And now I tell every investor on every webinar, this is a high risk speculative investment. We're going to give you all the reasons in this webinar of why we think it's a good investment, but just be aware, like, you can lose all your money. Do not put in any money that you cannot have locked up for a significant amount of time.
Hmm.
Do not put in any money that you cannot afford to lose, right? That would impact your finances, negatively in a substantial way. Just be prepared. It's a high risk investment. If you don't want to do that, go put it in the treasuries, right? Like, go put it in a money market account, or something. But
Hmm.
this is for people that they're trying to get outsized returns and they're willing to take the risk in order to do so.
Agree. Yeah.
Very cool. So tell us a little bit more. Kind of in our final few minutes here, Kyle. Tell us a little bit more about your practice today. I have a lot of students in our group now that are always asking me these questions about legal stuff, which I'm obviously not qualified to answer, and so I have to send them to someone like yourself to have a conversation. But how can you help people that are getting started in real estate today and they need some kind of legal representative for their deals?
I think that's probably two part. So one of the I've kind of been going through a bit of a religious spiritual awakening personally, and I've kind of shifted my firm's focus lately away from, well, towards more of a value driven concept. And
Mm.
like, not just legal advice, not just practical advice, but just like, hey, just here's things that are happening, right? Like don't doubt yourself. Like, this is just kind of the market right now. Like, I don't want to say that I'm a quasi therapist, because that's not where I'm trying to go with that. But I think, like, if all your attorney is doing is being a legal advisor, I don't think that's good enough this day and age, to be honest with you.
Mm.
I think that I think that there needs to be more, and there should be more, right? Um, so I guess if you're looking to hire anybody, this is an engineer, a property manager, attorney, accountant, whatever. I think you need to think about these two things for adding anybody on your team. That's fit and capacity. If you don't get the sense that the attorney is there for you, then they may not be, right? Like, personalities matter, right? Like, I'm not the most buttoned up person, and I don't try to be. Like, I've responded to questions you've texted me with gifts before, right? Like, that's just who I am. I take your matter seriously. I just don't take myself sometimes that seriously, right? So I recognize that not every fit is going to be right with compatible with every personality type. So I think the first thing you want to do is make sure there's a right fit. The second thing that I think you want to do is ask the attorney, including me, what is your capacity? Because the number one bar complaint is not fees. It's really not even negligence. It's responsiveness.
Mm.
Most attorneys operate from a scarcity mindset, and so do most entrepreneurs. I get it, whatever. But a lot of attorneys will operate from a scarcity mindset. And I'm a firm believer personally that if you say yes to everyone, you will eventually say no to everyone. Yeah, we can do your deal. Yeah, we have time. Yeah, we can, take on your matter. And then you eventually, no, I can't get to that Thursday. No, I won't be able to get to it, over the weekend. No, I'm not going to be able to make that call. Something came up, right? And then you're just kind of sitting back waiting 2 weeks just to get basic level feedback from an attorney who should have been able to answer it with a 10-minute email response max, right? So I think people should really ask capacity driven questions, because a lot of people will have more work than they can handle because they just think somebody's going to leave, and that's the reason people leave, is because you overshot your capacity anyways. At my firm, we're very thoughtful of our capacity, and we grow slowly but organically. I don't run ads and things like that, and we've just gotten repeat business and referrals. And it's because what was important to me, apart from delivering a good client service, obviously, was making sure I always had the capacity to bring on the next client. So that would be that. And can I leave your audience with like one more tip? This is kind of more
please.
Operators. I think one shift that a lot of people are trying to do in any space, oil and gas, commercial real estate, Bitcoin, whatever, is they're starting to rely on fund-to-fund managers, other capital raisers to kind of save their deal kind of thing. One phrase that you'll probably hear a lot is other people's money. That's like you and your investors. What you really don't want to get in the habit of is relying on other people's money, right? Like some capital raising groups, investors. Because then you don't really have control over your deal anymore. I think the psychology of that stems from, especially beginners, is they think that their deal isn't valuable enough, or they're not worthy enough to go to high net worth investors and have a conversation about investing. And I would just say that if you're a faith-based person at all, you have a moral obligation, I think, to discuss financial investments with high net worth individuals to further God's kingdom or their family or their philanthropic goals. And I think if you're afraid to talk to someone successful about possibly investing in your deal, I don't think that's you talking. I think that's the negative influence, whether that's, something that you don't believe in yourself or whatever. But I think you owe it to yourself to just discuss the investment opportunity. And Jonathan, as you know, very rarely do you get hate from someone above you, right? Anybody, I do not know a successful multi-millionaire, successful business owner that would laugh at me for presenting an opportunity to them. They'd want to hear it. They might not say yes, but they would never make fun of me for trying because they once had to try themselves. So to the person out there that's like, I'm just afraid to raise capital and I'm scared, and I think people would say, well, what do you know about X? I would encourage you to think more positively about yourself. And oftentimes people aren't thinking about you or as negatively about you as you think they are. And I would encourage you to try to unravel that negative self-doubt, because it's holding you back from your own successes.
Man, I don't think I can come up with a better closing than that. That's fantastic, and I couldn't agree more. I can't think of many people that are more successful than me that have been negative towards me in any way, shape, or form, right? And yeah, the times that we've done the worst is always when we've doubted ourselves and haven't taken the shot, so to speak. So really appreciate you passing that on. Kyle, it's been such a great conversation today. If someone wants to get in touch with you, what's the best way to do so?
I'm on Instagram and Twitter at Kyle, Kyle, Swafford, SWA, F as in Frank, F as in Frank, ORD, Kyle Swafford, ESQ. That's short for Esquire. So Kyle Swafford, ESQ, both Twitter and Instagram. On LinkedIn, it's just Kyle Swafford. And then my website is aptly named Swafford Law LLC.com, Swafford Law LLC.com. But if you want to reach me on email, it's Kyle, Kyle, at SwaffordLawLLC.com, Kyle at SwaffordLawLLC.com.
That's awesome. Kyle, thanks again for joining the show. We're better for it. I know the listeners are going to get a lot of value out of this. And to all the listeners, thanks for joining us today. It's been a good conversation, and we'll see you back next week for another episode of the Apogee Wealth Podcast. Thanks for tuning into the Apogee Wealth Podcast. I certainly hope you found something valuable in this episode that you can take with you and apply to your own investing journey. If you found the show valuable, you can subscribe so you don't miss further episodes. And if you'd like to learn more about ourselves or our company, you can visit our website, www.apogeemfc.com. We have a ton of educational resources that I'm sure you'll find quite valuable. Until next time, happy investing.